The content here is for informational purpose only and should not be taken as legal, business, or tax advice or be used to evaluate any investment of security and is not directed at any investor or potential investor in any AlphaSwap podcasts.
Hello and welcome everyone. I'm Khing and this is the AlphaSwap podcast. Every week we'll be discussing a top investment idea from the platform and have an in-depth conversation with the user who posted the idea. You can learn more and join our community at alphaswap.io. This week, instead of discussing a trade idea from the platform, we'll be doing a deep dive on a trending topic in the markets. We're doing this based on a room we host on Clubhouse every week. So if you're in Clubhouse and you're interested, please follow us. What we discussed recently is SPACs, which is obviously a very hot topic and an up-and-coming asset class. I'm hosting this podcast together with Bert, as well as Jeroen. Briefly on myself, before founding AlphaSwap, I was in the hedge fund industry for many years and ran my own fund. Bert?
Yes, hi everyone. My name is Albertus Rigter. My daily job, I work in the investment team of a hedge fund, which is specialized in credit strategies, alternative credit strategies. Also, I'm an advisor to AlphaSwap, investment platform. I've spent my entire career on the buy side, about 22 years already. So look, our topic today is SPACs. I think a lot of you would know how of SPACs. Many of you probably do not know how they exactly work, so we thought it would be useful to actually talk about that. It's a little bit sort of the economics of a SPAC, why they're so popular, how you can invest in them, what the risks are as well. And first of all, it's been a huge boom, right? There's been about 150 SPACs year to date in 2021. Last year, we've seen 250 SPACs in total, so we're already beyond sort of the SPAC printing rate that we saw last year. And in 2019, only about 59 were issued. So there's been exponential growth. They are extremely popular with retail investors. Actually, a larger part of the SPAC is actually dominated by retail investors. Low rates also has something to do with it because the financing rates are actually as low as they can be. But also the sponsor earn quite a lot in issuing SPACs, which is probably also a reason why the sponsors like them. And last but not least, they're rather liquid, so you can go in and out of a SPAC. So these are some of the reasons that they're extremely popular. I think maybe if we can start with this, Khing, would you mind sort of giving us a refresher of how these now functions? What are the sort of the structures of what's the structure of a SPAC?
Absolutely. That's a good way to start, Bert. So a SPAC is essentially a cash shell, right? It's a special purpose acquisition company. And the first step is really for a sponsor to take this cash vehicle public. So it's an actual IPO, which does a roadshow with an underwriter, like a normal IPO process. But what's sort of unique about it is that in this case, there's no actual company with operations that is being sold to the public. It's just a cash shell. So the issue price is always $10. And as a buyer at primary, you also receive essentially half a warrant per share. And what it does is the sponsor then has a 2-year time period within which it will have to find a target to purchase with this cash shell. And as a shareholder, you effectively have the right to redeem after 2 years if you don't like that deal. So in the meantime, your cash is being put in a trust. So it's 100% safe. There's effectively no downside. The sponsor has 2 years to find a target. And usually within those 2 years, we'll come back to all the shareholders with a deal, at which point the different shareholders have the option to redeem and also vote on that deal. So that's really the basic structure. So the what's called the front end money, which is really the people buying into the IPO, which is a combination of hedge funds and probably some retail, but it's a capital market transaction. So clearly funds have better access to these. And there's different ways that they play that, right? But at the outset, it's an attractive trade in this current low rate environment, because if as a IPO shareholder you choose to keep your stock, you effectively have your warrant upside, but you have zero downside. And in a low rate environment, that opportunity cost is not too high.
And just before we go further, are there any sectors which are sort of more prevalent in SPACs than others?
Yeah, that's a good point. So basically, the interesting thing is, if you are a high growth company, effectively a scale up, and you want to take your company public, what is kind of difficult about is projections, because in an IPO process, you can't actually show projections. So that's a difficulty in getting the right price for your company when you IPO. The beauty of a SPAC is that the SPAC itself does a private deal because it requires or a stake in a company. That deal is privately negotiated, and therefore projections are possible. So by that for that very reason, a number of high-profile SPAC deals have been done in the arena of high-growth companies. So fintech, space, healthcare, a lot of these high-growth industries they lend themselves well, with the added link now that a lot of SPAC investors expect this kind of explosive trajectory for the SPAC share price, because some of them have been actually very good performers. So a lot of SPAC investors, they are sort of hoping / expecting for a material upside. They're not doing it for 20% upside.
So it feels like if you're a retail investor, this is a way to actually access something that is usually dominated by private equity funds, right? Would you mind running us through sort of the risk? Because it feels also like the sponsor has a huge incentive in these SPACs, right? And the way that sort of SPAC offers make it look, it's almost like a free option. Sort of you if you don't like the deal, you actually exit. If you like the deal, you stick with it. But is there any risk associated with sort of how these economics work between what the sponsor gets and what you retain as sort of the SPAC holder?
Yeah, it's very important. So that's sort of what makes the structure unique. The sponsor, who's again, it's either a company, very often an alternative asset manager, or an individual who takes his SPAC public, gets phenomenal economics. And it's typically 20% of the deal size upon closing of a deal. And the amazing thing is that this is not like in hedge fund space, a performance fee, or in private equity, a carry. It's effectively a deal fee. So no matter how that deal then actually performs, the sponsor will have received shares in a new transaction at almost for free, at an extremely high discount. So it's at that sort of 20%. So, and this causes dilution for the SPAC shareholders. So if you think about the risk for retail, as mentioned before, the actual SPAC IPO is very often, for the majority, placed or even pre-placed with hedge funds and other large funds. So for retail, it's not possible to get a big allocation there. So the way to access SPAC deals from a retail perspective is buying these shares in the secondary market. And these are fairly large market cap companies, right? SPACs are 500 million, a billion. You've seen a 2, 3, 4 billion SPAC. So the liquidity is there. The difference then is that you don't get the free warrant. That's the first difference. And the second difference is that very often that SPAC will trade a bit above the $10, which is the issue price. Depending on how hot the deal is, who the sponsor is, it may trade at 11, 12, sometimes even much higher levels, which, if you think about it, is sort of amazing, given that it's a cash shell, right? We've seen an extreme example where a SPAC was trading at $40 plus on the expectation of a big transaction. So that's one end where the retail comes out probably slightly worse than institutional capital. And obviously these SPACs, they run their own lives in the secondary market. So it's very well possible that you buy it at 14, but then it trades at 12 2 weeks later. That's sort of the secondary market volatility that occurs there.
So it's very important to understand that dilution effect that happens once you sort of de-SPAC, right? That's the term I think they use, and to see how significant that is. If you look at the history, I've looked at some numbers. It seems like a lot of SPACs in the end, people sort of ask for their cash back once the de-SPAC process is actually happening. We obviously have a long history. We have a very short, large history because there were so many SPACs happening in 2020 and 2021, and it will take 2 years to see, whether the right deal is found by the SPAC issuer, the sponsor, if you go. How has the performance been overall for an investor in SPACs?
Yeah, that's a good question. There's some numbers out there, and I think there's sort of different time periods. There was SPACs have been around for a while, right? They've been around since the sort of 2000s, and there was a little spurt before the global financial crisis. Then it's been very quiet, and a lot of SPACs that were done sort of since the GFC until a couple of years ago had, I guess, in many cases, average performance. A lot of deals also didn't happen. So the sponsor would come with a acquisition target, bring it to shareholders, but the deal got voted down, or in many cases redeemed. People redeemed. So that's sort of I guess one set of the data. The more recent data, which, as you said, Bert, is an enormous amount of issuance last year and this year. There we still have to wait and see how it goes over the next year or two. But the deals that we have seen have typically performed quite well, and that's probably because there's clearly been some beta. The markets have been sort of buoyant in the last year or so, but also the type of companies that these SPACs bought were in sectors that were had huge multiple expansion. And you just to go a little bit through the technicalities of this, as you mentioned, when a SPAC buys an acquisition target, it's called de-SPACing, because what happens, it's also called reverse acquisition. The SPAC buys a company, but that company is going to be the real operating entity. So that company takes over the name of the SPAC, and boom, you've got a listed vehicle that has the company name. The SPAC changes name. And the way it works is if a sponsor raises a SPAC of, say, 500 million, then typically the deal size will be between 3 and 5 times that SPAC size. So between 1.5 and called 2.5 billion of size. So if, say, it's lower end, if it's 1.5 billion of deal size, then the SPAC and the listed shares will comprise a third of the new company. And the economics that go to the sponsor are on the original SPAC size. So in this case, 500 million, which is the dilution for the existing investors. So I think that's important to note. So it's not like these SPACs will buy an entire company. In many cases, they just buy a percentage of a company, and that percentage then becomes listed, which also, by the way, may cause some liquidity issues, because then you have a company that's worth, say, 1.5, 2 billion, but the free float is only 500. And then on top of that, a number of stakeholders have locked up shares, right? The selling shareholders have locked up shares, management has locked up shares, the sponsors locked up shares. So very often the liquidity in that structure post de-SPACing may not be that great, actually.
Interesting, and we obviously, SPAC is popular for many reasons, as we said earlier on. But the way you describe it, if your sort of economics as a sponsor are based on the original IPO, and that's about 20% or to 25%, and half of the SPAC IPO participants choose not to participate in the merger, that 20% remains on the original amount and is actually divided on half, which means that there's actually a huge dilution. So I think probably our listeners should be aware of the actual risk entailed. One other thing,
Sorry, just on that, Bert, because it's a good point. One thing to sort of complete the picture on a transaction, what a sponsor then will often do is do a PIPE, a private investment in public equity. So the SPAC in its original document will have a minimum cash balance that it needs to complete the deal. So suppose that's 50%, it means that no more than 50% of the shareholders can redeem, because then your cash balance drops below 50%. But for a sponsor to be able to do a larger deal or reduce that risk of not being the minimum cash balance, it will often do a PIPE. So it will go to, very often, again, hedge funds, and essentially pitch a deal. So look, we're about to do an acquisition, we need more cash. It will often be around $10 again, even though the share price may be a bit higher at that point. So it's, in that sense, an attractive transaction. And in that way, hedge funds top up their exposure to be able to complete the deal. That's probably important to mention, because as you say, in many cases, shareholders will redeem because they get a free warrant, free upside, and they redeem. So it's a very asymmetric trade. So to counter the risk, because I guess for a sponsor, the worst thing that can happen is not being able to close a deal, they will do a PIPE.
That's really important. And Now, sort of, is SPAC now already an asset class? Is there, can we, like convertibles, like high yield, is there now a new asset class called SPAC? Is it already so popular that we can call it an asset class?
Yeah, it's a good thing. To me, I really see it as another financing vehicle, another innovation, just like CLOs, CDOs in structured credit. We saw business development companies to buy yielding assets. And this is another big one. I think the big question is, where from here? Is this a fad that's gonna blow over, or is it there to stay and will only become bigger? Certainly where we are right now, there's been an enormous amount of new SPACs filed. There's talks about SPACs being listed in Asia as well. In Europe, Amsterdam is pushing this hard. Probably London's going to do something, because so far the dominance has been in the US. So there's a big trend towards it. And I think what will stay, what probably isn't going to go away, is essentially this arbitrage where the demand for a SPAC from a seller perspective, from a company perspective, is going to remain there for the reasons mentioned earlier, where it could very likely be a much more efficient process than IPOing, despite some of the high costs, because an IPO is also not cheap, right? The underwriting fee is high, and if a stock has a pop, which the underwriter wants, or everybody wants, basically, it means as a seller you've left money on the table. So that's a bit different for a SPAC. So from that perspective, I think it's very important that this may be an innovation, creating, I guess, a semi-asset class that is probably there to stay. Low rates have helped, so it'll be very interesting to see what happens when rates come down a bit. There's definitely the elements that you mentioned, where now retail investors have access to deals that were historically more in the domain of private equity or venture capital. And I guess one big question is, if you go through different stages, right? We've seen the IPO buyers, then we've seen the PIPE buyers. There's some secondary in the middle. In the end of the day, this will be a listed vehicle, a normal stock, and we've seen some of them traded at very high levels, which means the marginal buyer, the last buyers of these vehicles are definitely back. So if the performance continues to do well, great. If not, and it turns out to be retail buyers, and obviously it's been again one of those cases where retail is left holding the bag. Okay,
well, that was very interesting, Khing. I hope everyone hope this was useful to everyone. So to summarize, SPAC is an interesting asset class. It's not there to go away very soon. It's good for retail investors to access the market. It's good for sponsors because the economics are high. It's good for companies because it's a maybe more efficient way than a usual IPO to access the public markets. However, hopefully you always also get a little bit an idea of the risks, especially as a retail investor. And before investing in SPAC, I hope you consider those. So thanks, Khing. Thanks a lot for these insights.
Great. Thank you, Bert. And I hope to see you again all next week. Thank you.